Hey everyone, welcome back to the Market Interest, where we talk stocks, finance, and the markets. Today we have special guest Mr. Randy Neely, the president and CEO of TransGlobe Energy Corporation, an international oil and gas company. Their NASDAQ ticker is TGA. Randy, thanks for being here with us today.
Thank you for having me, Brian.
The energy sector has been performing exceptionally well for the past year, 2 years. What's your outlook on the industry and energy prices moving forward?
I think put the Ukraine crisis aside. I think we were looking to have a fairly robust recovery in energy in general, and I think that was about just the recovery of the industry, recovery of the marketplace, and really shortness of supply. So this was going to be somewhat of a demand-driven recovery, and we would likely see rising oil prices and rising gas prices. Now, the Ukraine crisis has sort of accelerated that because of the sanctions, why we're seeing a rise in oil prices pretty dramatic over the last few months. But I think even you put that aside, we would have seen higher prices through this year and into next year. And that comes about from a long period of underinvestment in the industry. And we're talking, the better part of the last decade of underinvestment.
It's funny you say that because you're one step ahead of me. Russia is a major supplier, major producer of the world's energy. Do you see any conflicts between Russia and Ukraine affecting your business opportunities in any way?
Well, it doesn't directly affect us in the sense of where we operate, in Egypt and in Canada. Where the impact comes is really supply chain, and so we're seeing that kind of throughout the industry. There's a lot of steel that comes out of Ukraine and Russia, and of course there's certain supply chains that are breaking down because of that, and so we're seeing tightness of certain material supplies, just as there's a need to ramp up operations. So you're seeing kind of inflation across the board, and then you're seeing shortness. So you're seeing a lot of people trying to stockpile. So we're seeing that impact our business, not so much in the next 3 to 6 months, but beyond that, we're starting to become more concerned about maintaining our level of activity.
So most of TransGlobe's operations are in Egypt, but you have an exciting asset in Canada. What made you decide to enter into the North American market, especially with it being so competitive in Canada? And can you share some of your excitement around some of those assets specifically in Canada?
We entered into Canada in very late 2016, and at the time it was really meant as a bit of another leg on the stool of operating, internationally in Egypt for a long period of time. And Egypt had gone through Arab Spring, and there was a shortness there was delayed payments, and that was a big concern for us over a number of years. And that's improved markedly since then. But at the time, we were looking for another where else could we be investing where we would counterbalance that risk. And Canada was one of the top places we could go to because of the very low political risk. So at the time, we bought those assets with a view that we could grow them to being a fairly substantial part of the business. Of course, lingering low commodity prices through the latter part of the last decade kept that in check, so that the operation stayed really just constant. We kind of just reinvested the existing cash flow into the asset and tried to keep it as steady as possible. More recently, though, with better prices comes more opportunity for us, and the assets themselves have performed very, very well since we started drilling in the southern part of our acreage, which was really untested lands, and allowed us to grow the production there, at a higher rate given the per well deliverability.
Now, I know that you've mentioned in the past that you were considering potentially selling the Canadian asset. Do you have any considerations at this point, whether it's keeping the asset, spinning it off, mergers, acquisitions?
Yeah, you're definitely picking up on some of the things we've talked about in the past, which were, we didn't feel that we were getting any recognition for the value of Canada. And I guess now it's hard to really say where the recognition of value is in a company's stock. Are we getting full recognition for Egypt and under recognition of Canada? Are we getting recognition for Canada and not enough for Egypt? It's hard to really tell. But we like to still say that we're fairly agnostic about it. We sort of feel like at the end of the day, we want to deliver value to our shareholders. And if the best route to getting value for those assets in Canada is to simply sell them or spin them off, then we absolutely would see that. But if if you've looked at our more recent presentation, you can see that we do believe that we can grow that Canadian business pretty substantially over the next few years, even within its own cash flow, and that could really underpin a fairly substantial distribution to our shareholders, whether that would come in the form of dividends or share buybacks, but it could be a very substantial portion of our business. So it may still just be 6 or 12 months out before we get better recognition for those assets. Again, fairly agnostic about it. At the end of the day, if it makes more sense to sell it, we're fine to sell it.
TransGlobe has what I'd like to consider a revenue sharing agreement with Egypt, and it sounds like the Egyptian government has created more incentives for your company. So can you tell us a little bit more about those agreements and how it can benefit shareholders?
Yeah, that agreement obviously took a long time coming. It was almost, I hate to tell you, but it's almost 5 years of work to get that done. And we were pioneers in it. We were the leaders. We came up with the idea. Other much larger companies followed in our footsteps. It's tough when you're the little company plowing the road. But what happened is that the sort of two things coalesced. We were sort of coming to the end of some of our contracts and really the viability of those contracts to some degree. And the government of Egypt was looking for how do we actually generate incentives to get companies to drill more and produce more oil and gas in the country, because they've got a growing population base and an energy deficit. And so those two things came together, being myself with the head of the government oil company having a conversation, and I said to him, hey, look, we think we can grow our production fairly substantially. There's a lot more oil for us to drill and develop in our projects. We just don't have any fiscal incentive to do it. So he encouraged me to come back with proposals, and that's how it all began. What it does for us, what we did is we took 3 separate concessions agreements, so revenue sharing, if you like, and we combined them into one, and that did a number of things. So first off, we combined them into one. We improved the overall fiscal terms on all 3. There was 3 different sets of fiscal terms. We made them all one set of fiscal terms, and better than even the best one that we had. Then what we did is we extended that license out for another 15 years, plus we have an option to extend it to another 5 years, so let's call it 20 years total. And what it did is, on average, we increased our share of the oil. When we used to think about it in the kind of sub $80 range, it would be about a 15% incremental change, 15% of the total. So actually, from our position, it was more like about a 30% increase. And so what that does is our share of the oil is larger. Therefore, we were able to not only make a higher return, but we're also able to recycle our cash a lot faster and reinvest it a lot faster, which was the purpose. The government there saw that they actually see a finite life on oil in particular. They see it being another 10 to 15 years. I'm not sure if they've changed their mind on that, but that was in the early parts of the discussions. So they felt like we need to develop the resources as quickly as possible and get revenue for them before they're no longer necessary.
Interesting. Wow. 10 years. I mean, 10 years comes quick,
I'm not sure I buy into 10 years, but, I think we all have a view that at some point in time, we'll be moving on to, different forms of energy, and that there'll be less demand, at least in proportion to the overall energy platform. So that's the question of, will you ever get lower than 100 million in our lifetimes, 100 million barrels a day of demand, or will 100 million barrels of demand just be a much smaller portion of the total energy being consumed?
Yeah, I mean, it makes sense. I mean, we're also a very, innovative species. So I believe there are some ways where we can innovate and create something else. So your recent shareholder presentation speaks about the company targeting a minimum 75% free cash flow distribution. Can you tell us about the dividend structure that you guys have in place?
Yeah, I mean, it's sort of in keeping with a few things. One is, we had been waiting for this consolidation of our licenses to come together for some time, and even we had announced it in late 2020, and finally, signed into law in late 2021, and then effective early 2022. And so we had been investing quite a lot during that period, and even though the contract is effective back to February 1st, 2020, in terms of when it's actually the terms are applied, we had been not earning that yet. So it takes a lot. So there's a disconnect between those two. Now that'll get caught up in the new period. But what we felt was with higher oil prices, with the better terms, we wanted to get back to paying a dividend. So we said, look, we've got the financial capability to declare a dividend now, but we wanted to make sure that our investors understood that we didn't want to just say, oh, we're giving you 10 cents, and that just seems pretty minor. But we wanted to make sure that they understood that our intent is to distribute a significant portion of our free cash flow, and that's so cash flow after capital. And as a result, we thought, look, 75%, when you do the math on our expected cash flow, is a fairly substantial amount. And that may still come in the form of share buybacks as well as dividends, but we're going to start with dividends. And what we said was every 6 months, we will assess another distribution. And from that, we'll determine whether we're paying a dividend, or we're doing share buyback, or possibly doing both. But the intent on a longer term basis is that 75% of our free cash flow will be distributed to our shareholders in one form or another.
I think even just the mere fact that you guys are considering buybacks is it's comforting. It's showing that you have confidence within your own company, within your management, and being able to produce even more dividends in the future. What level do you guys need prices to be at in order to consistently pay a dividend, whether it is a dividend with buyback or cash dividend?
Well, I'll roll back a little bit and I'll talk about Egypt versus Canada. But so in Egypt, when we were working on this change in the contract, we were working under the old umbrella of lower for longer. That was, if you remember the oil industry, it was like lower prices for longer. We're not going to see higher prices for a long time. So our whole negotiation was that prices were going to be somewhere in kind of $50 to $60 range was what our expectation was. And so even in that range, there would, we would manage the business in a way that there'd be distributions. Canada is a different entity. It's on a per barrel basis, particularly the oil, it's a bit more profitable, and you can see that in our presentation. But I think if we're $60 or above, there'd be distributions. Now, of course, it'll be 75% of free cash flow, but free cash flow at $60 is going to be a lot smaller than free cash flow at $100. So that's really going to be the variation.
Gotcha. And how long is the life cycle with one of your Canadian assets? Is it like 10 years, 20 years? How long can this stretch out for?
The Canadian asset, production against reserves, you've got about 20-year reserve life in Canada in terms of, production being about 2,500 barrels a day and reserves being a little under 20 million barrels. In Egypt, it's much shorter, but there's also a slight difference in terms of recognition of the reserves there. And I'm speaking as an accountant, I'm not an engineer, but our reserve life in Egypt is probably around 6 to 7 years, and our reserve life in Canada is 20. So the Canadian assets have quite a bit of reserve life left in them, and a lot of development opportunity. The Egyptian assets have larger contingent resource element, which has to be done in order to graduate those contingent resources into reserves. And so, it wouldn't be fair to say it's apples to apples comparison between the two, but we've got quite a few reserves and contingent resources to produce and develop in the coming years.
That's great. Have you considered employing more capital into Canada instead of Egypt?
Yeah, it's I think the thing is in Canada we have it's a resource play, so it's sort of we have like 100 locations plus or minus, not all in the reserve. Some are contingent resources, but the sort of spread of the outcome on those is much narrower than Egypt has a whole series of different contingent resource projects, some of which will work, some will work great, some won't work at all. So over time, you'll have to tick through those. So it's probably a more predictable place to develop versus Egypt. And Egypt, there's some elements that have to be sequential, where Canada is more like if you had the surface location to drill the wells, you could drill the wells and create the production and therefore value. So it's a different risk profile. Yeah, it's a debate we have internally all the time on where we're going to invest. But historically, we've left these as kind of two completely discrete business units where the Canadian asset generates cash. We reinvest that cash to generate cash flow in Canada. And in Egypt, we do the same thing. It's just right now they're both going to do very, very well.
That's great. Randy, I really appreciate your time today. Before we go, can you tell our viewers what the top reason is why they should be considering investing in TransGlobe Energy?
Well, I think the top reason is that we're dedicated to providing returns to shareholders. I mean, we're not about growing. We don't want to be 12,000 today and 20,000 in a year from now. What we want to do is we want to be 12,000 today and be very profitable, and we want to share that value with our shareholders, as in a balanced way, so that we can continue and be sustainable as a business, but also provide our shareholders real returns, on a regular basis. So, I think there's a lot of companies out there that are all trying to do sort of the similar thing, and I think, if you look at our record, when we've said we're going to do something, we do it. We said we were going to consolidate these licenses in Egypt. It took a long time, but we did it. And 7-8 years ago, we said we're going to start selling our oil directly in Egypt. And lots of people said we wouldn't do it, but we did it. And we're going to do this too.
That's great. Well, Randy, thank you so much for your time today. We look forward to seeing you hopefully again in the near future. So there we go. Randy Neely, the CEO and president of TransGlobe Energy Corporation, ticker TGA. Now, keep in mind, guys, that this is a small cap energy company. So with a small cap stock, there's going to be some volatility inherent within the business. Also, it's in the energy sector. So again, it's going to have some volatility to it. So make sure you do your due diligence prior to investing. If you have any questions about it, if it's appropriate for you, make sure you click the link down in the description down below, and we can set up a one-on-one interview, see if this does make sense for your portfolio or if there's some other options as well. And really appreciate your time, guys. Look forward to seeing you all next week. Take care.